Hey everyone, and welcome back to the Tesla Stock Podcast. Tesla finally unveiled its answer to the demand problem, launching its new, more affordable cars this week after days of teasing. The reaction from the market? A big disappointment. So why is Wall Street shrugging off the very thing Tesla needs most right now? The answer might lie in a massive $20 billion deal for another one of Elon Musk's companies. With the stock now trading around the $431 mark, let's break it down. Our top story is the launch of the new stripped-back standard versions of the Model Y and Model 3. After teasing a big event for October 7th, the company officially released the new vehicles, which are designed to be a cheaper entry point into the Tesla ecosystem. The new Model Y Standard starts at $39,990, and the Model 3 Standard starts at $36,990. That's about a $5,000 discount from the flagship models. But to get that price, Tesla has removed a host of features, including auto steer, the rear passenger screen, leather seats, and even radios. But here's the crucial part of the story, and the reason for the market's disappointment. For a U.S. buyer, this new cheaper car is actually more expensive than the premium version was just over a week ago. Before September 30th, you could buy a standard Model Y for about $45,000 and then get the $7,500 federal tax credit, bringing your effective cost down to $37,500. Today, that tax credit is gone, and the new, less featured model costs about $40,000, so you're paying more for less car. This is a far cry from the revolutionary, ground-up $25,000 car that was once promised, and it's still more expensive than competitors like the Nissan Leaf. So, how did Wall Street react to Tesla's big reveal? The stock dropped more than 4% on the day of the announcement. It's a clear signal that investors were not impressed. But more telling is what analysts have been saying. Wedbush analyst Dan Ives, one of the biggest bulls on the street, wrote that he was relatively disappointed with the new vehicles. And other analysts who are raising their price targets are making it explicitly clear that their bullishness has nothing to do with these new cars. For example, a Stifel analyst just raised his price target to $483, but cited the robotaxi and self-driving advancements as the main reason. This is a fascinating and crucial signal from the market. Tesla's primary solution to its biggest near-term problem, slowing demand in a post-subsidy world, was met with a collective shrug from the very analysts who are pushing the stock to new highs. It shows just how completely the investment thesis for Tesla has detached from the day-to-day business of selling cars. Wall Street isn't all that focused on EVs anymore. For them, AI is what matters. And if you want to know why Wall Street is shrugging, our final story provides the answer. While Tesla is making incremental, defensive moves in its car business, the truly massive, world-changing capital is being assembled for Elon Musk's separate artificial intelligence startup, xAI. According to a new report from Bloomberg, xAI is in the process of raising a staggering $20 billion. The report details a highly creative financing structure, where a special-purpose vehicle will buy NVIDIA chips and then lease them back to xAI, allowing the company to scale its computing power without putting traditional debt on its own balance sheet. The list of rumored investors includes NVIDIA itself and the private equity giant Apollo Global Management. But here's the twist. Just last month, Elon Musk publicly denied that xAI was raising any capital, calling such reports fake news. The article suggests that this is a familiar pattern of Musk using optics and semantics to project strength and control the narrative. By using this complex leasing structure, he can perhaps technically argue that the company itself isn't raising capital, even as billions of dollars are flooding in on its behalf. This is the real story. This is what has captured Wall Street's imagination. And it's why a slightly cheaper Model Y with no radio just doesn't move the needle for them anymore. So, to sum it all up, Tesla launched its new, more affordable standard models, but the market reacted with disappointment, as they're effectively more expensive for many U.S. buyers and are a far cry from the truly affordable car that was once promised. Wall Street analysts have made it clear that they are focused on the long-term AI story, not these incremental product changes, and are largely ignoring the new vehicles. And the real excitement and the truly massive capital in the AI space seems to be coalescing around Elon Musk's separate venture, xAI, which is reportedly in the process of raising a massive $20 billion. This brings me to my question for you. What do you make of Wall Street's reaction? Are they right to ignore the near-term car business and focus entirely on the long-term AI and robotics vision? Or are they overlooking the fundamental challenges in the business that pays the bills today and getting distracted by the hype around another one of Elon Musk's ventures? A venture that isn't even part of Tesla? Let me know where you stand in the comments below. As always, if you found this breakdown valuable, please hit that like button, subscribe to the Tesla Stock Podcast, and be sure to turn on notifications so you never miss an update. Thanks for listening, and we'll see you next time.